A gold and silver opportunity. Like this won't come around again somewhere right now. A handful of central banks are quietly making a decision that most investors won't understand until it's far too late. Silver has just lost nearly half its value. Gold has slipped from its highs, and on every screen and every headline, it looks like fear. It looks like collapse. But what if the price you're watching isn't the real story at all? What if the real story is buried in a vault, in a shipping restriction, in a number almost nobody is tracking? By the end of this video, you will understand why the world's most patient money is moving in the opposite direction of everyone else. And you will understand why that matters more than any headline you've read this year. Stay with us, because what happens next changes everything. Welcome back to Precious Metals Intelligence, the channel built for people who prefer to understand markets rather than react to them. If you're new here, this channel exists for one reason: to give business professionals, investors, and long-term thinkers a clear, honest read on where gold, silver, and the broader economy are actually heading, without the noise and without the hype. Before we go further, we'd love to know, where are you watching from today? Drop your city or country in the comments below. It always means a great deal to see just how far this conversation reaches. And if this kind of grounded, strategic analysis is useful to you, consider joining the channel by subscribing. It helps this work continue, and it helps more serious-minded viewers find their way here. For millions of people who own gold and silver, the last few months have felt like a gut punch. Anyone who quietly set money aside in these metals to protect their savings has watched something painful happen. Silver has fallen by roughly half of its value since the start of the year. Gold has slipped too, though by a smaller amount. And for many investors, the question isn't just what happened, it's did I make a mistake? This is the moment where most people start to doubt themselves. They open their portfolio, see red numbers, and assume the worst. They start to wonder if everything they believed about gold and silver was wrong. But before anyone jumps to that conclusion, there is something important to understand. The price on the screen is not always telling the full story. In fact, in this case, it may be hiding the real one. To understand what is actually going on, it helps to look at the numbers side by side. Earlier this year, silver reached an all-time high. Then, over just a few months, it lost more than half of its value. Gold also pulled back from its own high point, but by a much smaller amount, roughly a quarter. Two metals, same few months, same headlines, same global tension, yet one metal lost far more than the other. That difference is not random, it is a signal. Analysts have a simple way of tracking this gap. It is called the gold to silver ratio, and it measures how many ounces of silver it takes to buy a single ounce of gold. A few months ago, that number was around 55. By the middle of the year, it had climbed to around 70. In plain terms, silver became far cheaper compared to gold than it had been just weeks earlier. Something pulled these two metals apart, and almost nobody stopped to ask what that something was. This is where most casual observers get the story wrong. There's a war unfolding in the Middle East, oil prices are climbing, every news channel is filled with tension and uncertainty, and for generations, people have been taught a simple rule. When the world feels dangerous, gold goes up. Gold is supposed to be the safe place people run to when they are afraid. So the question naturally follows, if the world feels this unstable, why is gold falling instead of rising? This is exactly the kind of moment where fear takes over and logic gets pushed aside. Investors see falling prices during a time of global tension, and they assume something is broken. They assume the old rules about gold no longer apply. Some panic, some sell. Most simply feel confused and unsettled, unsure of what to trust anymore. But professionals in the financial world are not looking at the same signals as everyday investors. They are not reacting to headlines about war or fear. They are watching something far less dramatic and far more powerful. In the short term, gold does not really move because of fear. It moves because of interest rates, and more specifically, because of what investors expect interest rates to do next. This single idea is the key to understanding everything that has happened over the past few months, and it will be explained in full detail very soon. For now, the most important thing to understand is this: the story being told by the price on the screen is incomplete. It looks like fear. It looks like panic. It looks like the world has stopped trusting gold and silver at the exact moment it should be trusting them the most. But underneath that surface, a different and far more calculated force is at work, one that has nothing to do with emotion and everything to do with cold financial logic. This is not a story about panic. It is a story about pressure, patience, and timing. And once the real mechanism behind these price moves becomes clear, the picture looks very different from what the headlines suggest. Investors who understand this shift early will be in a very different position than those who simply watch the numbers fall and assume the worst. In the next part of this story, that mechanism will be explained clearly and simply so that anyone watching can understand exactly why gold behaves the way it does, and why silver is being pulled by an entirely different force altogether. Most people think of gold as a kind of emotional barometer. When the world feels dangerous, they expect it to rise. When calm returns, they expect it to fall. This idea has been repeated so many times that almost nobody questions it. But this idea, while comforting, is incomplete. And in a year defined by war, inflation, and uncertainty, that gap between belief and reality has become impossible to ignore. To understand what is really driving gold, it helps to think about what gold actually is as a financial asset. Gold does not pay interest. It does not pay a dividend. If someone holds an ounce of gold for a year, they end that year with the same ounce of gold, nothing more. This might sound like a small detail, but it changes everything about how large investors think about the metal. Now picture a different kind of asset, a government bond backed by the state, paying close to 5% a year simply for holding it. No risk, no effort, just steady income. For a person managing a small amount of savings, this comparison might not matter much. But for someone managing millions or billions of dollars, this comparison matters enormously. They have to constantly decide where every dollar should sit. And when a safe, boring bond pays 5% while gold pays nothing at all, a large portion of that money quietly shifts away from gold and into bonds. This is not driven by fear. It is not driven by panic. It is driven by simple math. When large investors move money out of gold and into higher paying assets, gold prices come under pressure. This is often called the opportunity cost of holding gold. It is not that investors think gold is worthless. It is that gold competes with every other place money could go. And when interest rates are high, gold becomes a less attractive place to park capital. This single idea explains far more than most people realize. Consider the chain of events that has unfolded over the past year. War breaks out, oil prices rise, rising oil pushes inflation higher. To fight that inflation, the people who control interest rates are forced to keep those rates high or even raise them further. In other words, the war itself is not what is pressuring gold. The war is pushing up inflation, and that inflation is keeping interest rates elevated, and it is those interest rates that are holding gold back. The war and the price of gold are connected, but not in the direct way most people assume. This is the part of the story that rarely gets explained clearly, and it is the reason so many investors feel confused right now. They are watching frightening headlines and expecting gold to rise without understanding that the connection between fear and gold price runs through interest rates first. Once this mechanism becomes clear, the recent drop in gold prices stops looking like a mystery and starts looking like a predictable, almost mechanical response to rising rates. Silver, however, tells a more complicated story. Like gold, silver is affected by interest rates in exactly the same way. When bonds pay more, some money leaves silver too. But silver carries a second identity that gold does not share. Silver is not only a store value, it is also an industrial metal used in electronics, solar panels, electric vehicles, and the vast infrastructure being built to support artificial intelligence. More than half of all silver produced each year is not saved or stored. It is used up in factories and manufacturing lines around the world. This creates a second layer of pressure on silver that gold simply does not experience. When interest rates rise, they do not just make gold less attractive. They also tend to slow down the broader economy. And a slower economy means fewer cars being built, fewer solar panels being installed, and fewer electronics being manufactured. For silver, this becomes a second blow layered on top of the first. Gold absorbs one kind of pressure. Silver absorbs two. This helps explain why silver has fallen so much further than gold over the same short period of time. It is not that silver is less valuable or less trusted. It is that silver sits at the intersection of two powerful forces at once, financial and industrial, and both of them have been pushing in the same direction recently. But this is also exactly where the story becomes far more interesting. Because underneath this short-term pressure, something else has been quietly building for years, something that very few investors have been paying attention to. And once that hidden factor is understood, the entire picture surrounding silver begins to shift. By this point, one truth has become clear. Gold moves mostly because of interest rates. Silver moves because of interest rates too, but it also carries the extra weight of being an industrial metal, tied to factories, electronics, and clean energy. That alone explains why silver fell harder than gold in recent months. But there is another layer to this story, one that has almost nothing to do with interest rates at all, and it may be the most important part of the entire picture. For the past several years, the world has been quietly using more silver than it produces. This has not happened once or twice. It has happened every single year going back to 2021. Each year, factories, solar farms, and electronics makers have pulled more silver out of the ground and out of storage than mining companies have been able to replace. To cover this gap, the difference had to come from somewhere else, and that somewhere else has been the world's silver reserves sitting in vaults. Over just 5 years, this steady drain has added up to a staggering amount. More than 760 million ounces of silver have been pulled out of above-ground stockpiles and used up. To put that number into perspective, all the mines on the planet combined only produce around 830 million ounces in an entire year. In other words, the world has burned through nearly a full year's worth of global mining output just by draining its savings account of silver 1 year at a time. This raises an obvious question. If silver is genuinely running short, why has its price been falling instead of rising? Normally, when something becomes scarce, its price climbs, and that higher price encourages more production until the shortage corrects itself. This is basic economics, and it usually works. But silver breaks this pattern, and it does so for two specific reasons that most casual investors never learn. The first reason lies in how silver actually comes out of the ground. A large majority of the world's silver, roughly 70%, is not mined on purpose. It is a byproduct. Mining companies are digging for copper, zinc, or lead, and silver simply comes along for the ride, buried in the same rock. This means silver production has very little to do with the price of silver itself. A mining company is not going to dig for more copper just because silver happens to be valuable at the moment. Silver supply trickles out at roughly the same pace, no matter what its price is doing. The second reason involves the buyers themselves. Industries that rely on silver, such as electronics manufacturers and solar panel producers, do not have an easy way to replace it. Silver is the best conductor of electricity available, and there is no practical substitute at scale. This means that when prices rise, these industries generally have to keep buying anyway, because their products simply cannot function without it. At the same time, demand for silver keeps climbing steadily, driven by solar energy expansion, electric vehicles, and the enormous data centers now being built to support artificial intelligence. Every one of these industries needs silver, and none of them can easily walk away from it. So on one side, supply barely responds to price at all. On the other side, demand keeps growing regardless of price. These two forces have been pulling apart for years, quietly widening the gap that has already drained hundreds of millions of ounces from global vaults. Making matters more difficult, the flow of new silver into the market has recently slowed even further. Mexico, the largest silver-producing country in the world, saw its mine output fall to its lowest level in a decade, as the ore being extracted has become thinner and harder to process. Peru, another major producer, spent much of this year under a formally declared energy emergency, disrupting normal operations. Two of the world's most important silver-producing nations are now producing less at the very moment when global reserves are already stretched thin. This is the quiet, structural story sitting underneath the falling price. It is not visible on a stock chart. It does not make headlines the way war or inflation does, but it represents a slow-moving imbalance between what the world needs and what the world is able to supply. And that imbalance has been building for years, largely unnoticed. While the price on the screen suggests silver is losing value and losing importance, the underlying reality tells a very different story. Somewhere beneath the surface, the numbers do not lie, even when the price does. And as the next part of this story will show, some of the world's most careful, long-term thinkers have already noticed this gap, and they are quietly positioning themselves in response. While ordinary investors have been watching their gold and silver holdings lose value and feeling uneasy, a very different group of players has been making a very different set of decisions. These are not retail investors reacting to headlines. These are governments, central banks, and large institutions, and their actions speak far louder than any panic seen on trading screens. Earlier this year, the United States government made a quiet but significant move. It added silver to its official list of critical minerals, a short list of materials the country considers essential and cannot afford to run short of. This is not a symbolic gesture. It is a formal acknowledgement that silver plays a critical role in national infrastructure, technology, and security. Around the same time, China took its own significant step. It placed new restrictions on silver leaving its borders, a move very similar to actions it has already taken with rare earth metals in the past. When a country begins restricting the export of a resource, it is rarely reacting to short-term price movements. It is protecting something it believes will matter far more in the future than it does today. These are not decisions made in a panic. They are not reactions to a single bad headline or a difficult week in the markets. These are long-term calculated moves made by people who study global resources far more closely than the average investor ever will. When governments begin quietly securing and restricting a resource, it is worth paying close attention because they are rarely wrong about what matters over the long run. At the same time, central banks around the world have continued to accumulate gold at a remarkable pace. For 3 of the past 4 years, central banks have purchased over 1,000 tons of gold annually, more than double the average pace seen just a few years earlier. This buying has been so significant that gold has now overtaken United States treasuries as the most held reserve asset among central banks worldwide, something that has not happened in roughly 3 decades. Even outside of traditional institutions, this pattern continues. In 2025, a major stablecoin company purchased more gold than almost every central bank in the world, trailing only one nation. This is not the behavior of an asset losing relevance. It is the behavior of an asset being quietly and deliberately accumulated by some of the most sophisticated financial players on the planet. This creates a striking contrast. On one side, everyday investors are watching prices fall and feeling nervous, some choosing to sell out of fear. On the other side, governments and institutions are doing the opposite, steadily accumulating and protecting these same resources, seemingly unbothered by short-term price swings. History has shown time and again that the patient, long-term thinkers tend to be positioned correctly far more often than those reacting emotionally to daily headlines. None of this means prices will rise immediately, or that short-term pressure from interest rates will disappear overnight, but it does suggest something important. The people with the most information, the most resources, and the longest time horizons are not behaving as though gold and silver are finished. They are behaving as though this moment matters, and as though patience will eventually be rewarded. If this way of looking at gold and silver, calm, structural, and grounded in real data, has been valuable, consider subscribing to Precious Metals Intelligence. This channel is built for people who prefer clarity over noise and long-term thinking over short-term reaction. And before moving on, it would mean a great deal to know where this is being watched from. Please take a moment to share your city or country in the comments below.